Welcome back, everybody, to the weekly market analysis. I'd like to take a moment to remind you to hit the like button and subscribe to the channel if you aren't already. Share this video with someone if you find it helpful. You can also follow me on Twitter at Mr. J. Thomason. I post semi-frequently on Twitter some different analysis and thoughts. You can also follow my weekly newsletter, which comes out every Sunday morning at befinanciallyfree.substack.com. The links to both my Twitter and my newsletter are in the description of the video below. And we'll go ahead and get started. Today was obviously a pretty sour end to the markets for the week. So today's price action actually led to the week or the markets being down for the week. So the S&P down for the week. Just about 0.3%, NASDAQ down a little over 0.5%, Russell down about a third of a percent, Dow about even on the week. And so just going to the daily chart, we obviously had a giant bearish engulfing candle on basically every equity index, well, except for the Russell and technically the Dow. We got the wicks on the outsides, but not the close. So that's interesting. I was kind of watching throughout the day. We got the bearish engulfing pretty quickly on the NASDAQ and then on the S&P. And we were flirting for quite a bit of the day on the Russell and on the Dow. So the question for today that we're asking is, are the markets going to crash? And today is actually 15 years to the day that the Lehman crash happened. So this is, you want to go back and take a look at that specific day. We have to go back on our S&P chart to 2008, and if we take a look here at September 15th, Monday the 15th was a day where the S&P was down a little over 5% on the breaking news that Lehman was declaring bankruptcy. I think there are people out there who look for date correlations and things like that. And so obviously, what's the news for today? Well, the news for today has been basically the strike, the UAW strike, the United Auto Workers striking. There's concern about that. We obviously have had interesting news this week on the inflation front, with inflation picking up in terms of headline. Core still somewhat decelerating, but still inflation has been some news. But then you contrast that with the inflation expectations, which were actually down from the University of Michigan compared to last month, and it was a big drop. We've got strong economic news. One thing I want to point out before we get into the charts more is the big six, which are the NBER, or which are the indicators that the NBER looks at to declare recessions. And with the industrial production data updated today, we had a pretty huge acceleration, about 280 basis points on a 3-month annualized basis in terms of the acceleration, bringing our year-over-year change back to positive territory after having been negative for some time. Everything else is either at or above trend, or in the case of real personal income ex transfer, that's a little bit under trend, but not anything that would suggest a recession happening anytime soon. So some strong data this week. Retail sales were up as well. Nothing in the near term pointing to any economic weakness, but of course the downside to that is the growing concern over inflation resuming, which is something to be aware of. And then today we also had a triple witching OPEX, which was the largest on record. I think over 3 trillion in options expiring right here today on September 15th. So a lot of people concerned about that. There was a little bit of upward drift this week in the equity indices, and obviously some concerns about what price action is going to look like going into next week. So again, the question for today is, are the markets about to crash? I think there is a lot of fear out there that the markets will crash. If we just look back, take a step back and look at the technical levels, you know, we're above our 13-week moving average, which is what I use as kind of the base of the tide line. And the tide is strong still. Tide is bullish. We still have the tide line above the control line. And that's the case on the NASDAQ and as well as on the Dow. The Russell, obviously, we are also still in bullish tide, but that trend is a lot weaker. Man, look at that line. I put that on the chart a while back, and it's just been a pretty solid place to buy off of. Gotten spikes off of that. It's been good support. But yeah, as far as the trend goes, I mean, our trend is still intact, both from a trend line standpoint as well as from a tide standpoint. We have been kind of correcting and moving sideways, consolidating, but if you were to look at it in terms of, if I pull up, oh sorry, that's going to take a second to pull up. If we look at a side-by-side at a weekly and daily, and I've got crude oil right here that I'll show you in just a second, but I want to go back to my S&P chart. If you look here, I mean, like the RSIs are not in any position where where there is really a whole lot of concern. I mean, as far as, you know, people looking at this chart saying, wow, the S&P is still overdone, and that may be true from a valuations standpoint, but right now the valuations don't seem to matter. On a technical standpoint, I mean, we've got the RSI could, I mean, depending on how this sells down, the RSI could you know, come down to oversold or near oversold again. We've already got the daily stochastic moving down towards oversold, the weekly stochastic moving down. What I honestly think is going to happen is I think we're going to set up a bearish, because I think that in the next few months markets still have more upside to price in, and I actually think that what we're going to end up doing is getting a weekly bearish divergence, which I guess on the S&P we technically already have. I think we're going to get another wave of it. Of course, you know, anything could happen. I have some overlays which I use to measure risk in the market, so that's something I'm going to pay attention to. But I do still think that with the economy still strong, there's still a lot that could push equities up higher. There's a lot of reasons why I think, you know, equities can stand to move a little bit further. Not just the economic resiliency, but if we look at our bull-bear spread in terms of sentiment, the bull-bear spread is still, you know, it's not unreasonable at any point. Still trending towards bullishness, but not at a level that is concerning. If we look at it on a percentile basis, the big move was people became less bullish and more neutral. We didn't really see much of a change in terms of the bears in terms of sentiment. But the spread dropped pretty strongly, about, what is this, from the 62nd percentile to the 46th percentile. And so that's a pretty, you know, I haven't updated the top, sorry about that, but I would say that, you know, it's nothing to go like super all in long on, because the move was not from bullish to bearish, but from bullish to neutral. So a lot of undecidedness, I guess, or uncertainty here going forward, as well as when you look at the positioning chart, which, you know, if I only put up the equity indices here, you know, the positioning chart is more bearish than it is bullish. I mean, especially here on the Dow, you've got the large non-commercial speculators that are in the 20th percentile. I mean, everything is below the 50th. Well, not everything. You know, at least the larger speculators are below the 50th percentile, and then the smaller speculators, the non-reportables, are, you know, they're between 38 and 56%, and the large commercials are, you know, relatively long. especially in the S&P and in the Dow. And so there's nothing that is warning you that there's nothing to warn you that markets are like super overextended. So I think that's something to think about. So relative bullishness has tapered off. Positioning is still really not bullish, and the trend is still intact. And so I think when there is, I wrote this in my newsletter last week, when there are conflicting signals, then it's almost best to just go with the trend, because in these cases the trend is indeed your friend. Another thing that I think can contribute to bullish equities, we got this tide cross on a bullish tide cross on the dollar at the end of last week, but the dollar is super overbought. If I go to my side-by-side chart, we've got an overbought dollar, which is creating multiple bearish divergences on the daily MACD, and it's only a matter of time before we get a relief rally here, or a relief pullback, I guess we would say, which that would be good for equities. Yields are still kicking up to the upside. I think that this is obviously something that can weigh on markets. We're closing near the highs of the year and the highs of the cycle, and the tide is still bullish. So the trend here is up. So obviously that's something that you should be aware of. And I think what's interesting too is to see that the yields closed near the highs of the day, and there was a pretty strong push towards the end of the trading session, towards the end of the day. But the yield is, it's on the weekly chart. It's getting overdone, and obviously it can stay overdone for some time. But we've also been kind of setting up a couple of bearish divergences in a row on the weekly chart, so that's something you'll want to watch. We've got a bearish daily divergence setting up, so it's going to eventually be a good time to go long bonds for at least a trade, if not for the long term, but not yet. So that's going to take some time to line up. I want to go to gold. Gold got a pretty good day today, up on the week, but not able to close above the control line, piercing into the area between the control line and the tide line. The trajectory for this is still ultimately probably going to be down. I think again, today you get a bid in gold, but you didn't get really a bid in treasuries. And I think that if you can look at the TLT, TLT sold down pretty hard today. It's still at the range lows, and so why is gold then bid and treasuries aren't? It's one of those things where it doesn't make a lot of sense with inflation news. I think this is a panic play. Honestly, we'll see what happens next week, but I suspect I still think gold is gonna end up turning down. I'm looking for gold to move about like that into the fall. So we'll see what happens there. Crude oil has been the big one. This is something I want to spend a little bit of time on before we get off here. Crude oil, the trend is, the move has been strong. The trend is, the tide line is getting, pretty far away from the control line, which can happen. Look at the size of the gap between the tide and control line from the move from the last bullish tide cross, and this gives you the sense that you can see the red triangles. Normally the red triangles, when you see them, it's a warning sign, but when you're in a strong bull market, then especially when the trend has just changed, you tend to see a lot more of those triangles, and so they're not necessarily it doesn't mean short now. You have to look for multiple signals working together. So one thing that I would say here, if you want to look at crude oil on the side-by-side here, then one thing to note, it's nearly overbought on the weekly RSI. It definitely is overbought on the daily RSI, overbought on all the stochastics, and kind of working on its MACD daily bearish divergence. this could go for a bit longer. I'm not saying that you should go out and short it now, but I will say that it is getting to the point where it's a little bit too far, too extended. In fact, if you go to the positioning chart and you look at, if I just let me pull up the energy names that I look at. In crude oil, we had a pretty big jump in the positioning of the small speculators. This was closer to the 50th percentile previously, and the non-commercial large speculators saw their positioning to the long side increase, and we saw the requisite decline in positioning of the commercials, which are the hedgers. And so this is definitely a period of time where you don't want to be like jumping into oil. If you've missed this move, a lot of people have been in denial on the way up, and I've been talking about how once you see the tide cross, you get the pullback and then you take the trade. But this is getting pretty extended. You're going to want to watch for something to show you that the market is already saturated with longs, and that could take another week or two. But like crude oil should be on your radar for a tactical short. But obviously you want to wait until the market gives you something to show you that the market's too saturated. So one of the things I'll be watching next week is inventory numbers. If we get any more bullish inventory numbers and the market doesn't move strongly on them, or maybe something from OPEC Plus, or I don't know, then that'll be the clue that oil has gone too far, and you're going to look for a pullback. And when you do get a pullback in oil, you could see something pretty sizable. You could see this thing drop to 82, 81, 80 even on a considerable drop. So that would be worth the tactical trade. And then of course all the underlying, or all the oil related ETFs are all like well overextended. So something that you want to pay attention to. And then Bitcoin has seen a little bit of relief the last couple of days after getting a pretty significant drop. But right now it just doesn't look good. The environment doesn't seem very positive for crypto. So that'll be something that you want to potentially steer clear of. Although on today's price action we were down a couple hundred points, and now we're getting close to break even unchanged. So was this the opportunity to buy at this level before the price shoots back off again? Maybe. Definitely something you want to be aware of if you're into crypto. Anyway, we'll leave it there for this week. My opinion on this is that the markets still have some upside to go. I think the market is still relatively underpositioned, and in terms of sentiment, still too bearish as far as equities go for this to be at the top. So I think if the bulls bear sentiment had been higher, or if if the positioning had been stronger, then I think that might be different. But anyway, we'll leave it there. Hope you guys have a great weekend, and I'll see you guys next time.